is something that we mentioned actually last week. The Attorney General for California, she is refusing to sign it, calling the settlement inadequate. And the reason that it's inadequate, in her wisdom, and I would tend to agree, is it would limit her ability to bring civil charges against the mortgage lenders that wrongfully foreclosed on homeowners. She objected to an earlier version of the settlement in September as well. So she's playing a little hardball. It's funny how she seems to be the only one that's doing that, and everyone else is sort of playing politics at this point. And something that we pointed out when we discussed this, that if last week, if any of us had done something this horrendous, we would definitely be looking at jail time. And if you're not familiar with what happened was, the gist of it, and you could catch the whole story actually if you go to the 60 Minutes website. It's sort of scary, but the lenders hired a separate company to hire people to act as senior vice presidents and vice presidents of the bank and sign tens of thousands of these foreclosure affidavits attesting to the fact that they had personal information or they were personally aware of each one of these cases. And sort of, even though it's not humorous, what was humorous was some of the people that were signing it that were men employed just to sign all day long, that's all they would do, were signing a woman's name. And if we sat here and we fraudulently signed documents that were given to the court, we'd all be in trouble. But the banks being the banks, this settlement is just more about money than anything else. And although, again, that big number in the billions that they were talking about seems like a big number, which it sort of is, but when you break it down into everything that is involved with this and how many people it affected and how many people it will affect, it's really minuscule, because a lot of people are going to be left out in the cold not having anything. I mean, I don't know, James, what do you think about it?
Well, kind of touching on what we were recapping with last week, it's really one of those situations where when you break it down, it sounds like a huge number, but when you go per capita of the amount of people in the country, it's really not. Then it's the big concern I have, and I started recapping this and actually polling a bunch of people after we discussed this last week. It says for struggling homeowners. What is a struggling homeowner? That's the hugest question out there, and I really can't wait to see what they define it. And I know what it's, if I had to guess, what it's going to come out to. Well, if you're 3 months behind on your mortgage and you're then defined as a struggling homeowner. Well, are you? Are you a struggling homeowner at that point because you're not paying the mortgage anymore? To me, a struggling homeowner, that may be a struggling financial situation, and maybe they need to look at other alternatives such as a short sale,
right,
or maybe a bankruptcy, or maybe, I don't know, there could be many factors.
A struggling homeowner could be someone who is not paying their mortgage because that's why they're struggling, because they can't make the payment anymore, and they have to choose between making the payment or feeding their family, or keeping the lights on, or putting gas in their car. So to me, that's struggling. A person that is paying the mortgage but is scraping by to do so because they feel that's the right thing to do, like most of us have been brought up to do, they're also a struggling homeowner. So the people that even are current are still considered, in my eyes, struggling homeowners because they're looking at an upside-down mortgage.
Yep.
And they could be hundreds of thousands of dollars upside down, but they're still making the payment because that's what they believe the right thing to do. Now, any of our listeners out there, they could be in any of those situations or other situations, and certainly we encourage them to call and discuss anything or ask questions at 340-1590. That's 340-1590. And those people might be calling their banks, and the banks may be telling them, or the servicers may be telling them they have to keep current, and they're going to struggle to do so. They're going to deplete their savings. They may even deplete their retirement funds. No one can tell you not to pay your mortgage, even the banks or myself or anyone else. Obviously, that's a decision that you have to come to on your own, but certainly you need to look at your entire situation, because I can guarantee you that the banks and the federal government are certainly not going to just come in and give you a handout, even though some people might think that they are. It's not that easy. I've been doing this for 4 years now, And I've seen a lot of cases of people who have come in and have depleted everything that they've had and are now put into a corner where they don't even have money to move. And that's why a lot of these situations have come up now with these special programs that are actually giving incentive money to people to move. And again, people out there that are current on their mortgages or don't understand why we're giving them money, it's because they have nowhere to go and no money to even go anywhere. So they have to do something. I mean, this is a big quagmire.
Another piece is the majority of that money is for non-Fannie or Freddie Mac homes.
Right.
To explain what a Fannie, because I run in this to a lot on the mortgage side, people.
So this is going to narrow the window way down as to who could get this money, and maybe this is just looking like a help,
right?
More so than actually coming through as help for people.
Majority of homes in the United States are sold off to Freddie Mac, and Fannie Mae. Now, those are your typical loans of a 30-year fixed loan. It could be an ARM, but most of the time it's a 30-year fixed loan, 20% down. There could have been other factors too.
Well, they know if all of those people fit into this program, there's not enough money for all of the people.
Correct.
So what they've done is they've made it such a fringe who can get in on this.
Just so we understand, especially for the people out there that are listening, about half of all U.S. mortgages are owned by Fannie or Freddie. That's about 31 million mortgages that are not going to be part of this settlement. They are not eligible for it. So again, who are the banks really helping through all of this? It's a very small amount, and then when you break it down, like they're saying that these people have lost their homes are going to be reimbursed approximately on the average $1,800, and some of those people may not even get that even might qualify for it because the money is going to disappear. Mm-hmm. And I think what California is doing is saying, this isn't enough. These people committed fraud on the American people, and they did it blatantly and openly. And, just throwing some money at it is not good enough. There needs to be some accountability. And I think that that's the right approach. It seems to me like California is sort of an island by themselves right now because everyone else seems to be
a lot of
wanting
times
to do
they're
it.
first to do things. They're on the cusp always.
Yeah, they're always different. I know.
Yeah.
Well, Florida ain't far behind though. No. One of the things though to look at the other side of the fence. All right, so we are kind of bashing the efforts that were put forth, but at least there is some sort of effort to go out there to give somebody an option.
But it's really not a help if it doesn't apply to anybody.
No. But at least it's something.
It looks like we're helping.
It's almost similar to the HARP program. The HARP is the Home Affordable Refinance Program. It actually was started. It came out in August of 2009, and it was designed for people who are upside down in the homes to get out of an ARM, who couldn't normally refinance. I mean, an ARM is an adjustable rate mortgage where now it's, say, 3 years that was fixed at a certain interest rate, a nice low rate, almost like I want to call it a teaser rate to get in, say 2% for 3 years. The next thing you know, after 3 years, it balloons up to 7%. And then each year thereafter, it can adjust up or down. But people, in my experience, is when you put someone in the mortgage payment they have on day one is what they expect to pay on month 360.
Yeah, but even if it is fixed, it still can change with the fluctuation of your taxes and your insurance. So any mortgage can go up.
Right, but that's not the mortgage. Mm-hmm. That's the taxes, insurance, and the property. Which even if the home is paid for cash, that can happen. Your tax insurance will change.
But that can push you out of your payment, your comfort zone of that payment too.
Sure, it definitely can. That's why it's also important, I believe, to have a review of your insurance each and every year. Call up your insurance agent if they're not calling you. Actually, if your insurance agent isn't calling you once a year for a review, find another one because they should. It's that important. I mean, because insurance companies, especially for homeowners insurance, they're not going to call you and say, "Oh, guess what? It's going lower this year." How many times?
Actually, I just got my renewal. It's double.
But you'll never get the call when it comes in lower, do you?
Well, that's not going to happen.
It's when
I won't get that call because it's not going down anytime soon.
Well, I must have a good insurance agent because they call me.
Oh, really? Let's get a guest on the show.
We'll have to talk after the show here.
That's good. Yeah. So, but the point that I was trying to get to was on that home affordable refinance program. There are some lenders out there now that they modified it. I'm sorry, they modified this original HARP program to now what's called HARP 2.0. And like many programs that are out there, just because it's available, a bank doesn't have to institute it, or they can institute it to what they call overlays to make the rules stricter. Just can't make them easier.
Yeah,
so make less people qualify for it then.
Yeah, well, that's the same thing they do with the short sale programs too. I mean, the Treasury Department will roll out a program and oversee it, but they leave it up to the lenders to modify it as they see fit, which, again, doesn't always help the situation. It really should just be one program. These are the guidelines. But what they do is they say, here are the guidelines, but if you see fit with your individual investors to change any of these things, go ahead. So what good is administering a program and throwing money at the program if a lot of that money is just going to go to waste, really? Right. I mean, and that's what happens. I mean, we have a lot of servicers and lenders out there that employ all these people, and you wonder what they really do, because I know from the negotiation side on short sales, there's no rhyme or reason to how these things go. And if any of you are facing foreclosure now or in a situation where you have to get rid of your house, short sale is the best option out of all the crappy options that you have. Mm-hmm. And I encourage you to call the show 340-1590 to discuss that, or you can contact us afterwards. But certainly what happens is you can have a deal that you think is going to be absolutely a nightmare to get approved, and it just flies through.
Do you think that it's easier to get a short sale through if the bank had mortgage insurance on that particular mortgage?
Sometimes.
Because they're already getting a little bit of cash.
Here's the thing, though, with that, and it's a very good question. The mortgage insurance company, you could have the lender and the investor be okay with everything. But then here comes the mortgage insurance company, because they have to approve the short sale as well, because now they're going to be getting a claim. Mm-hmm. And they're the ones, most of the time, that start fouling up
it's
the
an
short
insurance
sale.
Company. So.
Yeah, and that's because they want something. But you see, what's odd about that, quite frankly, is that if a mortgage insurance company is looking at a $200,000 loss, let's say, that they're going to have to pay $200,000 out or a portion thereof, and they're asking a homeowner to sign a promissory note at 0% interest over 60 months at $10,000. And if they don't want to do that, or they can't afford to do that, the deal doesn't go through. How is that $10,000 over 60 months at 0% interest really helping the insurance company do anything? And how does that make sense then to foul up a short sale that ends up going to foreclosure? Now you're not
nothing.
You're not going to get anything now, because most likely they may be forgiven of the debt, or they may file for bankruptcy. So again, it defies logic sometimes.
Phil, you brought up.
I'm Jeff.
Jeff.
Phil's not here today.
You brought up a good point with mortgage insurance, but a common question I get all the time is, what is mortgage insurance? A lot of people think it's hazard insurance or homeowners insurance. That's a synonymous term. Explain out what mortgage insurance is for people.
Well, I mean, what they call private mortgage insurance, PMI, it's there because a lot of times they don't put either an adequate down payment down, or it's really just a way of the lender or the ultimate investor being able to sort of protect themselves in case of a default. If the homeowner defaults on the loan and the bank has to go back and take the house back, they can put a claim in, just much like we can do if we total our car or get into an accident or health insurance. You put in a claim and you get paid, hopefully.
But it was all real pretty when people were just paying the fees,
right,
up until the time when so many people started to default, and the insurance company had to start, coughing
Well, now
I
want to point something else out too. A lot of people aren't aware of this, and a lot of people have second mortgages, and they are not paying for mortgage insurance on the second. But what they fail to realize is that the lenders, most of the time on a second mortgage, just so people understand, a second mortgage typically is given out by the lender and is not something that is sold. Okay, so that's something that the bank itself is on the hook for, whereas the first mortgage, they may have originated the loan, but they sell it on the secondary market, get their money out of it, and then they don't have to worry about it except servicing it.
How long has that been going on? I mean, when my mom and dad went and bought their house, they went down to their local bank, the bank carried the mortgage. How long have they been doing that? How long have they been bundling and selling mortgages on a secondary market?
Well,
Is this
I think
something
it's
fairly
been
new?
no,
or?
it's not new. It's been going on for a while. But the securitization, meaning the bundling, like you said, and selling it on Wall Street, basically, that's something that happened during the boom.
Ah.
And that sort of became almost like junk bonds in many ways.
Right.
But getting back to what I was talking about with the mortgage insurance, on the second mortgages, people aren't aware of this, but the lenders, most of the lenders on second mortgages, because they are personally on the hook for it in terms of the lender, is they take what they call credit indemnity out for themselves, which is mortgage insurance for themselves. If you default, they have mortgage insurance on that. And we run into short sale situations on seconds where they're saying, oh, well, the mortgage insurance company wants them to pay this. And I scratch my head and I say to the bank, it's a second mortgage. What are you talking about? And they say, well, this is mortgage insurance. Well, it's not mortgage insurance because my client or your client didn't sign anything, didn't pay anything. If you wanted to take out that insurance policy for yourself, that's up to you. But now you're going to ask someone who doesn't have any money to somehow now have to pay a mortgage insurance company on a policy that they knew nothing about or asked about. And that's something that again, could foul up a short sale.
Well, in a short sale or even in a foreclosure, is the second mortgage, they're not getting anything. I mean, if there is a foreclosure, that first mortgage is getting the house.
Pretty much that's the case.
And the
They're not going to
second
get
is left
anything.
going, oh, well, we messed up by giving these people more money.
But you'll be shocked how many second mortgages and even third mortgages foul up short sales because they want their money. And they want a certain amount. And the first drives the ship on a short sale.
Okay.
They're the ones that determine what everyone's going to get and what fees are going to be paid. And we can talk a little bit about that when we get back from the break.
You're listening to the Real Estate Pros Show here on WPSL 1590. Now back to your host, Jeff Rubin.
Thank you. And I encourage you at 340-1590 to call in with any comments, questions, thoughts, prayers, anything. 340-1590. We were talking about mortgage insurance and second mortgages and first mortgages, and just it's very messy and can be very convoluted. I've sometimes shocked, not as much now as I was prior, how many of the people on the other side from the lenders and the servicers don't really understand how these things work on themselves. And a lot of times we're the ones, or the negotiations company or the attorneys are the ones explaining to the employees of these banks and servicers how things work.
Well, short sales are fairly new too.
Well, not really. Short sales have been around for a long time, and they just haven't been widely...
You didn't hear about it.
Yeah, widely accepted, widely done, because
That's
it really
everyday
hasn't
word.
needed to be. It's the same thing with a modification. You know, I mean, people think that this is new. It's not. And I'll give you a great example. When I was much younger, I had a loan, and I was unemployed, and I called my lender because I was going to have trouble making a payment. And I called the lender, and I spoke to them, and I explained the situation to them. And I didn't have to send any paperwork in. I didn't have to sign anything. All they did for me on the phone was based, I guess, on my history of being on time. They took that payment for that month and they added it to the back end of the loan. So I missed a payment for the month and they didn't penalize me for it. So they modified my loan right there on the phone. Now, obviously, we're in much crazier times and they can't just be that simple. Right. But isn't that amazing that I was able to do that with a simple phone call and the person was empowered on the other end of the phone to just make the decision and do it? It wasn't months of wrangling and did you send the paperwork in? Yes, I did. Well, we don't have it, or we're missing pages 5 through 20. And how is that possible?
Or
when
that's
I sent
not this department. You'll need to start all over and talk to someone else.
Yeah. So, those things have been out there for a while, and they've always been out there. It's just not something that was widely accepted or widely practiced because it hadn't been this bad.
Maybe they didn't want everybody to know they could do this because then they'd be doing it for too many people. So instead they would be going, no, get your payment in or you're in big trouble.
Yeah. Well, there's a lot of lenders out there. Again, the federal government especially is very upset with a lot of these lenders when they advise people to miss a payment so they can modify their loan.
We can't do anything for you until you're behind.
Yeah, and they're not supposed to tell you that. I mean, it's a blatant violation. But I hear it all the time from people coming into my office that, well, I called my lender and I was shocked because they told me they couldn't help me because I'm making my payments. And if I missed a payment, then they could talk to me about a modification. Now, that's not really the case. And see, that again is someone on the other end of the phone that should be informed, and they're not. They don't know themselves that they don't have to be behind to be considered for a modification. But people just, whatever reason, the knowledge doesn't get passed down to the people answering the phones. Right. And when we talk about we were talking about mortgage insurance and why is it there and all that kind of stuff. And a lot of that has to do with like FHA loans. And FHA loans are designed to help people that, let's say, couldn't afford to buy a home. And I mean, especially these days, it's sort of scary to say that, but they can still get a loan. And a lot of FHA loans going on now. And a matter of fact, that's pretty much a lot of the loans, unless you've got a large cash down payment, most of them are still going through those federally sponsored programs. And I think you had some information on that, right?
I mean, generally, any lender wants to see someone who's coming to them for a loan put some skin in the game. And that's where that 20% number comes down. Now, a lot of people do think, well, I don't have 20% of the purchase price of the home to put down, so I just can't buy. Not necessarily the case. The FHA is a department of HUD. And it stands for the Federal Housing Administration. It's a government-sponsored entity, and their main job is to insure loans. As a general rule of thumb, if you would imagine your mortgage payment is, say, $200 a month, what they'll do is they'll tack on a percentage of that to insure that loan. Now, you'll make your payment, say it's, for example, $15. So that $15 extra is going to pay for an insurance policy. So the bank, if every month you pay your payment, that portion goes to pay back the principal and interest of your loan. Another portion goes into a bucket over at the FHA. It's you default on your loan on day one. The lender calls up the FHA and says, send me whatever it was, $100,000, and they'll get it. So lenders like
what
FHA
would be great,
loans.
Though, is at the end of that term, you got your money back.
Well, or you put the money down in down payment.
That would have been great. Yes.
Because
let me pay into this little kitty, but at the end I get my money back, or at least half.
Well, that's called a return of premium life insurance, probably, but that's a totally different topic and discussion. But the whole premise is that now the lender will sit here and say, okay, you only have to give us 3.5% down payment as a minimum versus 20%. And you can also I'll give you a better rate. You can actually get a better FHA rate than you will on a Fannie Mae or conforming rate. And it's generally, in some cases, an eighth to a quarter point better. You can get an FHA rate right now, 3.75, 3.625. It depends on the day. Obviously, interest rates fluctuate. But on the flip side, you look on a conforming. If you're perfect, you are crystal clear perfect, you're looking at 3.875 to 4.125 these days. So there's a problem with this, though, because as people now are putting just 3.5% down, it makes it easier for them to walk away. Actually, the USDA programs, I'm not saying you have to go out and buy a farm, but it's if you live in an area that's zoned USDA, for example, in Martin County, all of Martin County is USDA. Palm City, Stewart, Hutchinson Island, the Martin County section of Hutchinson Island, Jensen Beach, all USDA zone. Anything west of 95 in Port St Lucie,
like Tradition.
Yeah, it's all USDA zoned. You can get a 0% loan, and the rate's like 4%, and it's a very good loan. And what was happening was people didn't have that skin in the game. So now they don't have the skin in the game, and it makes it easier to say, I just can't afford it. I'm going to walk away. Now, more lenders are calling up the USDA, and they're calling up the FHA, and they're saying, we need money. You got these people walk away, send us this insured money. And now the FHA and USDA are running out of money. They're running out of funds. So how do they create funds? Because the government obviously is cutting money. They're not, spending and sending more money to these entities. They raise the mortgage insurance premiums. I remember FHA monthly mortgage insurance premium of 0.5% of whatever your payment was. So it was manageable. It was decent. Now that same program is 1.15%. Okay, so it's more than doubled because there's a lot more defaults. The USDA used to have 0% monthly mortgage insurance. Well, they call it a funding fee. Now it's minimal still. It's 0.3% of a percent. So it's small, but it's still the point of you're giving people a home without them putting skin in the game, and they're just going to walk away.
So
really,
people need to be more responsible, and that's one of the things. Even though I know a lot of people buying homes right now, I mean a lot of investors especially, but the people that are moving into these things, I see a lot of people that are still going with government programs. Now I think the statistics are showing that they're actually the originations are down for FHA,
right?
And delinquencies are up, and that's a direct correlation again to what you're saying. That people don't have as much skin in the game.
Well, especially if you paid $200 for the house and now it's worth say $60.
Mm-hmm. Right.
You're going to walk away. You don't have anything in it, and you're looking at paying double than what the value is today.
Right, but
you go across the street and buy a house.
Right.
For half the price.
But you see, the thing with that is it doesn't even you don't even have to be an FHA loan in those type of situations. Mm-hmm. I mean, if you put even 25% down on a house when it was worth $200,000 and now it's worth $80,000. I mean, that strictly, when you look at it, if you can't afford to make the payment, that's one thing. But a lot of people, what they're doing is what they call strategic defaults. And a strategic default is like a business decision. And that's what it is. They're looking at it and saying, well, why am I paying this money on this house at a $200,000 level when it's worth less than half of that? And why am I going to do that? Because when am I ever going to see a return on my investment of my 20%, let alone the bank getting any money? Because if I sell it, the bank takes that money. It's going to be a short sale. I'm not going to make any money. And a lot of people are doing that. Now, I used to work in real estate in Houston, Texas, when we had the crash for the oil industry and the S&L crisis. And what was happening there is the same thing that's happening here now, especially in Florida, where people, like you just mentioned, well, the house across the street is half the price. And what people were doing was, before they defaulted on their loans in Houston, what they were doing is they were going across the street buying that REO or short sale at half the price or less. They would move into that house, and then they default on the other house. Mm-hmm. And people say, yeah, but they ruin their credit. But they don't care at that point. You know why? Because they're in the other house. Right. Now, a lot of that is, very sketchy and fraudulent possibly, but the point is, it's done. Mm-hmm. And the banks have to put in systems in place, and that's what they have, where they look at a lot of paperwork. And that's why it's so highly paperwork intensive right now in terms of short sales especially. They want to make sure that the people that need the help are getting it. And that's the true essence of it. It doesn't always work out that way, because I've seen a lot of cases where people are just in bad situations and the banks just don't want to listen. And, and again, it comes down to sheer logic sometimes, and that's not always the case. And then you also have cases where people, they don't really need the help. They're just trying to strategically default. Okay, and those people don't deserve to get that kind of help. Right.
Sure.
See, in my opinion, and I'd love to hear this, open up to the callers at 340-1590, but in my opinion, there's some recent data that came out that would support that a short sale is better than a foreclosure. And they said here that 20% of the homes on the market right now are foreclosures. Now, of those 20% that are foreclosed homes, 34%, that's the number, 34% undervalued to the rest of the market. So a foreclosed home, on average, is 34% less than, if your house is worth $100,000, a foreclosed home is coming in 34% lower. That's 66%.
Yeah, that's a standard that's a standard in the industry. If it's a distressed property, even if it's equal or even greater in terms of the overall health of the property, that it's been maintained well, even if it's equal or greater than one that's next to it that's a traditional deal or not in distress, it's going to be discounted. What I find funny is that is something that's widely accepted, but when you are dealing with valuations with some of these lenders, they still want to value the property at the market rate.
Right.
And it's almost on a short sale. Right. It's very funny because they do that and they try to stick to their guns a lot of times unless you have a strong argument. And I mean, I can understand they're trying to get every dollar that they can out of it because you're losing money. But what's the alternative? If you stick to your guns too long, you lose a buyer. And then there's a good chance that property is going to go down in value even further. Right. And then eventually it is a good chance that you're going to end up with that property back in an REO or foreclosure, which is going to cost them more money in legal fees and carrying costs and maintenance and commissions and taxes and everything else. And then they're still going to have to sell it at a 34% discount. So how do they save money for the investor that way? So it's not as simple as us selling a property and doing all these things, and you think it is, and it should be, but it's a very frustrating time that we live in this industry right now when you're trying to clear inventory so we can get back to some type of normalcy. And there's a lot of red tape that's involved with these things. And something that I'd like to point out is we talked last week about the banks having specialized programs themselves, creating their own types of programs with incentive dollars. One of which that we discussed that when Phil was here last week, we talked about Bank of America and that they have a co-op program, they call it. And it basically calls for a percentage of your loan balance to be paid up to $20,000 as an incentive when you close on a short sale. And you're supposed to send it in. It's actually, the deadline's already passed. They had a very short window to send in for some type of an approval. And they would basically give you a pre-approved number, and then you'd go put it on the market. You have a year to sell it, and if you sell it in that year, then you would qualify to get that cash incentive at closing. What I find interesting is that I know personally that we have put several people into that program at our office at Rescue Florida Realty, and so far we haven't had one qualify. And I thought, I just can't be by myself with this because I've been doing this too long and have been successful at it, so I know that we're not doing anything wrong. At least I hope that we're not. And what I found when I was doing some research for the show was that the report is from Bank of America that only 60 deals have been done in the state since the program was implemented. That was back in October. 60. That's 60. And what I find funny is the Bank of America is saying that it's too early to judge the results and they expect it to improve. But how's that possible when the deadline's already passed to qualify for it? And I've got people that are in the program that are sitting in this, well, they're sitting in this limbo right now. I have 2 or 3 deals that are just sitting in limbo, waiting for Bank of America to make a decision. And nobody can give you a straight answer where they are. I mean, 3 months have gone by with no progress whatsoever.
We've also crossed into a new year, so maybe they're trying to spread it out a little bit.
I just find is this just a PR thing for Bank of America?
Are they giving the people the cash, or are they taking that 20 off of a shortage that they might have?
Well, it's cash that comes at closing that they get, and it's the way they do it is since I haven't completed one yet, but the way that I imagine that they do this is the same way that the government-sponsored program for HAFA, which is the Home Affordable Foreclosure Alternative Program, or the short sale program that the Treasury Department has implemented, is that they get a check at closing that comes out of the proceeds of the short sale. So that's included as another closing cost for the lender at closing. So that's what I'm presuming that's the way this works. That if you had a $100,000 short sale, that $20,000, let's say, if that's what you qualified for, or $5,000, or $10,000, or $15,000, is going to come off of just another closing cost. So they're going to net less money. Mm-hmm. Okay, but what I find even more interesting with that, and I get to the numbers here because I want to make sure I have it accurate, is that there's a report from thehousingwire.com that Chase and Bank of America may lose up to $131 million in HAMP payments, which is the modification program from the government. Those are incentive dollars that the bank is supposed to get paid when they do the right things or follow the program properly. And Chase and Bank of America, if they don't fail to improve performance in the Home Affordable Modification Program, the amount of payments they would lose total more than $131 million. And that's according to the Special Inspector General who runs the program. In the middle of last year, the Treasury Department withheld funds from Chase, BOA, and Wells Fargo for their poor performance in the program.
Yeah, I can't tell you how many calls I get during the week. I was at Chase, I was at Wells Fargo, I was at PNC, and they won't do my HARP loan. Or I was in the modification process, I got declined, they try to do a HARP for me, and they won't do it, and I'm declined. They're coming to me. And I'm like, well, how could it be that I can get it done, and the bank that you're at and the servicing cannot? It goes back to what you're saying here. And the process that in many cases we can get these done without appraisals. It's very limited income documentation. It should take no more than 10 to 20 days, and it's taken anywhere from 3 to 4 months to get one of these deals done.
Mm-hmm. Well, I could read a little bit more about this. It says that the compliance team looked at how each participating servicer performed when contacting homeowners, evaluating them for the program, and how they assisted with any questions or document submissions. Wells made immediate improvements the next quarter, and the withheld funds were returned to them. So kudos to Wells for
right.
Quickly rectifying and helping the people and running the program the way it's supposed to be done.
Well, to jump in on that, I'm not going to mention the bank's name because I don't want to give anyone bad press, but there's a bank, a major bank, that takes they call it an application fee. And if they cannot help you, they run you through this whole program, they keep it. You do not get that money back. It's non-refundable, even if they can't help you. Now, on the flip side, what we do over at Mortgage Plus, if I can't help you, here's your money back. I don't charge anyone anything until it comes under the HUD. But the kicker that you mentioned here was contacting the people.
Right.
They're actually telling me they wish there was a way that they could filter these people over to me, because they are 4 to 6 weeks just to get back to someone, to return a phone call. Mm-hmm. That's how backed up they are.
And now I'm going to be fair to Bank of America, too, because we've said some negative things about them. It says here Bank of America made some headway in the third quarter, enough for the Treasury Department to say the servicer needed only moderate improvement to regain its $63.7 million in incentive money. However, Chase has not made enough progress, and the Treasury Department warned the bank in December it could permanently withhold $67.3 million owed in HAMP payments. There's a quote here from the Special Inspector General that says, J.P. Morgan Chase's continuing refusal to comply with program requirements is deeply troubling, and there must be serious repercussions. And permanently withholding incentives from a servicer as recommended sends a strong signal to J.P. Morgan Chase and all other servicers that failure to perform at acceptable levels will result in serious consequences. And everyone sees all those great ads that Chase runs all over the place and how they're helping and they're reaching out to the community. And then here we have the Treasury Department telling them they're not doing anything.
It might take them 4 to 6 weeks to call someone back.
When you call, you can't get through. You get sucked into automation that ends up disconnecting you in the end.
I personally had that
So
happen.
that,
Yeah.
that happens.
Now, and this program is not about just bashing lenders.
Right,
I mean,
right.
but this stuff is very important, and I feel that you guys out there should be empowered with this information, understand it, because a lot of you may deal with these people directly, but you don't have to. If you have something that's on your mind and you want to call in at 340-1590, we can talk about it then. Or off the air, you certainly can give us a call. You can call the station here, and they can get it to us. Whether it has to do with a legal question, or it has to do with a real estate question, or it has to do with a loan. We certainly are here to help.
But what you're saying, though, is there's incentive money on the table that they're
Right.
leaving there on the table because they're not helping their customers.
But
And I'm not sure if I'm not. Yeah, and there could be a lot of reasons for that, and it could be that they're just not educating. Again, going back to what I was talking about earlier, they're not educating their own employees.
Maybe
how
they
to
don't
handle
have
these.
enough employees.
Maybe they don't have enough employees. And this is something, again, that I'd like to say is that I think the banks, they're hiring people that don't understand real estate. A lot of them are hiring people that just have a collections background.
Right.
And collections has nothing to do with a short sale or a foreclosure or helping people modify a loan.
Mm-hmm.
And it's the wrong type of personality to put in that position. There are so many people that are unemployed that have mortgage backgrounds, real estate backgrounds out there. Those are the people that should be handling these phone calls and handling these cases for the lenders. Because those people understand real estate. They understand loans. They understand what it takes, and they understand the language. I mean, it's just like any industry. It has its own language, own type of definitions, and I think that these things would get done a lot more efficiently and a lot quicker. But again, I don't really get why some of these lenders resist these things. There's obviously a bigger picture that we all don't understand.
Well, to shed some light on that, because coming from two major banks, I was with Wells Fargo, I was a manager at Chase, and it's not necessarily that they don't want to help people. It's a combination of things, and the biggest one, especially now, is capacity. I mean, there are so many people who are calling, and you have to also now weigh that out to, all right, who's truly in need of help here, and who just wants to jump on a bandwagon. That's something they need to weigh out, and that clogs the system. The second thing is, that's overhead. The more people you hire to answer a phone or to push through paperwork, that's more fixed cost to their bottom line. And if originations are down, they're losing money on these deals anyway, even though there's incentives out there.
It seems to me, though, that they want their cake and they want to eat it too, because they probably could have gotten someone to create a computer program that gave them the dates of their loans, who has fixed loans, who has adjustable loans, who has the highest rates, and they could have just adjusted everyone out of fairness.
No, they have systems. I can go in and have unlimited people to call. There's not enough people to staff. Now, and you know what? There's a reason why Wells Fargo made it through the whole banking disaster. There's a reason why Chase made it through, and not only lead through, but led it through. And one of the things I always say about Wells Fargo, they were always, in my opinion, the leader when a new program was going to come out, or the ones here when you had, I think we mentioned last week, the pick a pays, where it was, I mean, these negative amortization loans where they would just, if you did not truly know how to get into these things, you're done. Wells Fargo said, we will not touch that, refuse to touch it. Stated income on non-prime, I mean, you're talking about a person with a 580 credit score, high debt to income ratio. Wells Fargo said, no way. They actually, because the loan officers were saying, look, we can't compete with the rest of the market, they actually opened it up in a very limited, almost stringent capacity. But then again, now you look at all the banks that went under. What were the majority of the loans that caused them to go under? Stated income. You got the guy at the movie theater telling you he makes $100,000 a year. Look, unless he owns the movie theater, it's probably not the truth. Wells Fargo said, no way, we're not going to do it. So there's a lot of reason why they were restrictive to it. Conservative to the era of our bashing almost, because it's like, well, why won't you guys just do it? Well, because we have shareholders. We've been around for 100 years. We want to be around for another 100 years. So I do understand, appreciate that side of it, but then you also get the frustrating homeowner who truly does need the help, saying, look, I'm not lying. I do need assistance, and they get stuck in the system of piles and piles of paper for people who may not need it.
All right, well, we're going to take a break, and we'll be right back. Thank you.
Now back to the Real Estate Pros Show here on WPSL 1590. Back to your host, Jeff Rubin.
Thank you. And one of the things I wanted to talk about at the end of the show here has to do with the future. And what we're looking at is foreclosure, what they call a foreclosure pipeline, or what does it look like in the future. And I know everyone's been hearing that the foreclosures are down and delinquencies in some places are down, and that's all encouraging and it's all good. But you know, around this time of the year, you know, the holidays, and then coming into the beginning of the year, the last several years we've had that exact type of pattern, because they say that they dropped about 40% from year-end numbers from 2011. But it's not really something, according to LPS, Lender Processing Services, that does a lot of this reporting, is what they're saying is a little cause for celebration. It's really because of the moratorium that they put in place around the holidays, where they don't initiate new foreclosures because they don't want to kick people out around the holidays, that type of thing. It's, you know, very heartwarming. But the thing that's going on right now is they look at judicial states and non-judicial states for foreclosure. And for people who don't know what that is, Florida is a judicial state, which means that you have to go through the court system to foreclose. In a non-judicial state like in the Carolinas, they have non-judicial states, they don't have to do that. They can just foreclose and get the house back rather quickly. So the numbers may be skewed because of that also, because the systems in place move it along much quicker, and the homeowner doesn't really have many rights to defend themselves. But to give you an example, it says your 50% of loans in foreclosure in judicial states like Florida have not made a payment in 2 years.
That's half.
Yeah.
In 2 years.
Yes. As opposed to 28% in non-judicial states. And foreclosure sale rates in non-judicial states are about 4 times those in judicial states. Now, of course, those numbers are going to be skewed because you can do anything with numbers. Because a judicial state, it's going to take longer because of the courts. In a non-judicial state, it's going to be a lot quicker. So those numbers are going to be skewed. But what it's showing is that there is a large pipeline still, using that word, of coming foreclosures. Because, again, people who haven't paid in 2 years, they're in foreclosure, but the court systems are so backed up, and if Phil was here, he could attest to that. But it takes a long time for these things to run its course. And a lot of people do defend their rights, and I encourage them to do so because, again, you have rights. You might as well exercise them. Don't put your head in the sand if you get served, and you really should move forward quicker. Anyway, in terms of that, it looks like we're going to have quite a few more foreclosures this year, which is a good thing because we can get through some of this stuff that's going on. But what's happening is these things just take so long. That's why short sales are really the best alternative when you're facing a foreclosure. And the banks know this now. I mean, they're widely accepted at this point, and they have all these programs we've been talking about. But the sooner that we can get through this logjam, and really, again, short sales is really the quickest way of doing that. The sooner we can get back to some type of normalcy.
But if you can sit around for 2 years, are people just going, well, I'm going to sit around for 2 years?
Well, I don't blame them. I mean, honestly, if you didn't have to pay your mortgage and you could just live there rent-free, would you do that?
Yes.
Of
and
course.
I
I mean,
pocket the money,
it's sort
and
of
then I'd
human
go across the
nature.
street and find somebody who would do it by owner and carry the mortgage for me.
Well, yeah, and again, that comes down to, again, if people just have, I guess, a situation where they can't afford it and the lender is not making it easy for them to rectify the situation,
They're going to wait it out.
then people are going to wait it out. I mean, and I've seen that quite a few times, and I don't really have a problem with that. Now, we do have a caller, Gene.
Gene, you're on the air.
Yes, ma'am. Thank you.
Hi.
I've got maybe what's a silly question. I was involved with Bank United as my mortgagee, and this was back before Bank United went under. And I had approached them about a modification, and they gave me the usual spiel that you have to be 90 days in arrears in order to get one. So I said okay and stopped making my payments, and in 90 days went back and started working with them. And then within a month or two of that, they went bankrupt. And Bank United closed, the FDIC took them over, and a group of investors bought them.
Mm-hmm.
Well, when the investors took over and I approached them about a modification, they told me to go pound sand, and they filed foreclosure. I went to court, and in the course of explaining what had taken place with the judge, he looked at at the attorney that was there and said, well, now, are you Bank United or are you the new bank? And the guy said, well, we're the new bank. We took over. And he said, well, where is your paperwork showing that you have standing to do this? And the guy was dumbfounded. He didn't know what to say. And the judge said, well, you need to get your paperwork in order and come back.
Well, that's something that you're going to find in a lot of cases, and that's one of the big problems, and the judges do get aggravated by those types of things. It's a very interesting point, and unfortunately your story is not uncommon in this day and age, and if Phil was here, he again would attest to that. It's sort of unfortunate, and we are sort of running out of time.
We are out of time.
So, Gene, I'll tell you what, if you want to stay on hold, I'd be happy to pick up the phone afterwards and chat a little bit with you.
This is WPSL, Port St Lucie.